Hello again, and welcome to the Packaging Europe podcast. I'm your host, Victoria Hattersley, and today's episode is on the topic of mergers and acquisitions. Why is this? I'll try to give this short version. Many, if not all, of our audience will know, and well, it's been the talk of all the industry trade shows, that back in February this year, Mondi expressed an interest in acquiring DS Smith, which would have created, as its supporters argued, a European paper giant. However, in March, International Paper waded in with an offer of its own to buy DS Smith, and didn't end there. We subsequently learned that International Paper is itself potentially being acquired by the Brazilian paper producer Suzano, and this offer may be conditional on the latter abandoning its deal with DS Smith. So, I would also like to point out this is not the only big packaging merger story over the past few months. Last year, the fibre packaging producers Smurfit Kappa and Westrock confirmed an agreement to combine their businesses into a $20 billion company, I believe. At the time, this was huge news, but now seems pretty straightforward, actually, given the almost operatic story we've seen unfolding with DS Smith, etc. So that's the essence of it. But the discussion today is not going to be so much about what's going on with these specific deals as they're ongoing, but it did get me thinking about why such large mergers do cause such a stir across the entire value chain, and not just in the context of the packaging industry, but for any sector in which they take place. So I envisage this as a pretty non-technical discussion, partly because our listeners won't necessarily be experts in economic theory, but mainly, I should admit, because I'm not an expert in economic theory, unlike my guest today, who has very kindly agreed to find time in his busy schedule to speak with me. So I'd like to welcome Tim Galpin, who is Senior Lecturer in Strategy and Innovation at the Saïd Business School at the University of Oxford, and a business consultant, I believe, as well as the author of 6 management books. Hi, Tim. Have I left out anything there you'd like to mention?
No. I think you covered it.
Okay, thank you. So I think we've probably heard enough from me, so let's dive in. I'm actually going to start off with what may sound like a very basic or even, dare I say it, naive question. But in such situations, such as, for example, two companies combining to create a global paper giant, why does it create such a stir? I mean, to the average person on the street, it probably doesn't affect them at all, right? But what impact do mergers have on a sector, and what are the potential pros and cons for the entire value chain, would you say?
Yeah, so when you see big transformational deals, as they're called, announced, they make the headlines, right? The
Mm,
business news picks them up, general business news, the industry business news, because those are the ones that are really sexy and interesting to people because they involve company A taking over company B. And the reality is, though, in pretty much every industry, assets change hands all the time. So you have your asset transactions or deals. And you saw this with DS Smith over the years, has grown through purchasing some entire businesses, but a lot of assets.
mm,
A packaging plant here, a packaging plant there, adding it to their portfolio, their manufacturing portfolio. And so that's happening. That's about 70% of the global merger market. Our asset sales and purchases are always changing hands between organizations. And those don't typically make the news. They make the specific M&A Business Wire if you follow the M&A Business News. But for the most part, the Financial Times, the Wall Street Journal, the big industry uh, publications such as yours, they typically won't follow those. But the big deals, the deals you had mentioned, uh, will get picked up because
yeah.
that's company A going after company B. So will they get taken over? Will there be another bidder that comes into play, like happened with the International Paper DS Smith potential acquisition? So that's where all the intrigue comes in. It gets to be very interesting to people to see how it plays out.
Mm,
So that's kind of the first part of your question. The second part was how does it affect the value chain and the industry dynamics? Um, it goes back to strategy of the industry and the players in that industry, which includes the maturity of the industry. So as industries are in their early stages, very nascent, fragmented. You have what's called an accelerated growth and shakeout period, where the auto industry 100 years ago had hundreds of auto manufacturers, and a lot of them get swallowed up by the big ones, so they become the General Motors of the world, and now we're down to a handful of global auto manufacturers that we can all basically name. Same thing is happening in mining, oil and gas. Packaging is getting to that point now where it's been a fragmented industry. There's been some small players scattered around the globe, but the big players have consolidated. DS Smith has grown through acquisition, and now they're potentially being acquired. That's as an industry matures, you see that shakeout occur. And the reason that happens is because the small operators can do okay for a while, but then they reach their growth potential. They need more capital, more global reach, bigger distribution system. And the bigger players that are consolidating the industry through those acquisitions, like a DS Smith, for example, can offer that through their acquisitions of the smaller players. They can give them more global reach, make them a bigger part of their value chain, their supply chain. And there's also some synergies there for the big players that are doing the consolidation. So they can consolidate back office, headquarters, all the support functions, human resources, legal, finance, IT. So they get some cost savings out of that as well.
Okay. And why might it create unease in some areas?
Well, I mean, that's something that, depending on how fragmented the industry is or how consolidated it gets, it can cause some unease within the industry as well as with regulators. So from the regulator side, regulators don't like too few players in any industry. They don't like only a few players having the market power. That's the original reason for the antitrust regulation back in the day when the US established the antitrust regulation to break up Standard Oil. And that's how we got Exxon and Mobil and all the rest. And so the regulators are much more aggressive these days in various jurisdictions around the world, in the US, the EU, the UK, et cetera. They're really trying to prevent too much market power, essentially for controlling supply, controlling pricing in the hands of a few or even a single or just a couple entities. So it causes some scrutiny by the regulators, as you see in industry, especially with big deals announced, like a International Paper DS Smith type deal, because they will control the supply chain or a big portion of it. So the regulators will look at those deals. They may or may not get through the regulatory approval. They may have to make concessions and dispose of some assets. So there's still competition in the market as far as the regulators are concerned. Those are specific to each deal. They cause concern within the industry as well, because other players look and say, we're going to be dwarfed by the big player that's being formed, because we used to be fairly equal with them. Now they're doubling in size, for example, and now we're going to be half their size. And can we compete? They will have much more purchasing power. They'll have cost synergies where they can reduce their costs. They'll have more global reach from a sales and marketing perspective. So other players get concerned about that. And then it becomes a me too kind of thing where they have to start looking at doing deals. And this is where you'll see, once an industry starts the consolidation process, it accelerates because others have to participate in that or they get left behind and they become too small to compete with the bigger players that are doing that consolidation.
Something of an arms race in a way.
It does. It becomes a zero-sum game where, the bigger is better and those that get bigger end up winning. So you either end up getting, in that kind of scenario, you either end up being a buyer or you end up getting bought. or you get left behind. So it's all about the strategy of the particular organization. DS Smith wanted to grow. You have a choice of build or buy. You can build it organically. Greenfield operations takes longer. You've got to invest in, building sites and hiring people and et cetera, or you just go and buy it. You buy existing manufacturing capability. But then it becomes, does it fit with your organization strategically and organizationally? Does the culture fit? How easy is it going to be to integrate those operations, technology, and people into your organization? So if you're going to grow through acquisition, a best practice is to develop a repeatable programmatic capability where you have a playbook that you use, tools, templates, checklists for due diligence, integration, valuation, as well as what's called tacit knowledge, or the knowledge of your team, your deal-making team, your operators, to be able to integrate. And once you have that capability to grow through acquisition and repeat it and minimize your mistakes, and you become much, much more successful with a growth through acquisition strategy. So it's the strategy as well as the industry structure, the fragmentation, the maturity of the industry. They're all factors that come into play.
Okay, yeah, that's really clear. We're also, obviously, at Packaging Europe, we're really, really interested in focusing on the state of innovation, where it's leading, particularly when it comes to sustainability and circularity and that all kind of thing. And I'm kind of curious to know how generally market consolidation sort of impacts this, whether it has a positive or a negative impact, and I guess whether looking at competition laws can be useful here, if the latter.
Yeah, essentially, from a European perspective, there's a lot of business writing these days in the business press, the FT, and other kind of European-centric publications around trying to create European champions. It's been difficult. The EU is not a monolith, kind of like the US market. And so to create European champions, it has to get through the EU Commission regulatory approval and the other jurisdictions, Competition and Market Authority in the UK, et cetera. Each country within the EU has their own regulatory approvals. And
yes,
so
it's very fragmented.
Yeah, just creating those European champions is more difficult in Europe, or at least has been. Getting through that regulatory approval has been. You saw that with the Siemens Alstom proposed merger in the train manufacturing industry a few years ago. So, on the one hand, Europe wants to create these kind of European champions that can go and compete globally with the big global players in Asia, US, et cetera. But on the other hand, the regulators and the fragmentation of the European business structure has prevented that. So there's some thought that the regulators may let some of these mergers go through, these big acquisitions, to enable more of the European champions to be global players, but that's yet to be seen. From an ESG perspective, what you just mentioned, sustainability, especially in packaging, obviously there's various aspects of it that are really high profile these days from a sustainability, the S part of the ESG.
There are indeed,
or
yeah.
Actually, the S is social, the environmental, the E piece. So is really, you see some companies greening their portfolios through acquisition, because it's not just buying, more, for example, paper and sustainable packaging, but more, there's also the flip side. If somebody's buying, somebody's also selling. So some organizations will sell off their less sustainable or environmentally friendly business lines, like plastic packaging, for example. So, but there are others who will buy that because that's just part of their strategy. It's still a big part of the global demand. But you're seeing companies get more focused with their ESG from a strategic perspective, their portfolios of their assets. Are they going to be more ESG oriented, or are they going with more legacy type assets? And that's a strategic choice on the part of the organization. And from a regulatory perspective, that helps drive that too, as we see, supply chain coming into the European Commission ESG regulations now, this year actually, even more than it has been, where they have to be audited through their supply chain and how environmentally and socially and governance friendly are they in their all the way into their supply chain, not just within the four walls of their organization. So that is feeding into it. And ESG was not, when I got into M&A, 30 plus years ago, it wasn't even part of the merger and acquisition vocabulary. It wasn't even in the thought process. So
No.
today it's a topic in almost every deal. As whether it's part of the strategy of buying or selling, whether it's part of the due diligence, what types of environmental, social, or governance liabilities or advantages are we picking up through this acquisition? And then in the integration, how are we leveraging that? Is always part of the conversation these days.
Okay. So, I mean, is it important that even more so these days that companies, whatever their size, should approach these deals to look at long-term goals rather than short-term gains, particularly as you say now that the focus is very much on ESG outcomes and not just the financial bottom line?
Yeah, I mean, it's really organization specific. You'd like to think that most organizations would like to, you'd like to think that we're having the long-term view. The issue is a bit less so in the European public markets, where companies are trade shares and are publicly owned, versus the US markets, very short term. But in the public markets, you see a lot more short termism has crept up over the last 20 plus years or so. The quarterly earnings, the annual results. That's why a lot of companies have gone private. There's actually quite a few less publicly traded companies, actually about half the number of publicly traded companies as there was 25 years ago. Because a lot of companies have gone private to get out of the public markets, to take more of a long-term view, to have less of that kind of quarterly scrutiny from the shareholders and the analysts. And also the rise of private equity has taken a lot of companies private that were in the public market. So, but you could argue that those are fairly short term as well, because the private equity exit is looking, 5-7 years down the road to exit those investments. So it really comes down to one, are the companies publicly traded? Typically gives them more of a short-term focus, or are they privately held? Number two is really the leadership succession. The average tenure of the CEO in most Western companies is on average about 5 years, where they rotate in and out of that role. And when, a new leader comes in, they have to make a new mark. The current leader is measured on, share performance, which a big portion of that is growth. Their pay packages include those shares. So, they want to grow the company, grow the earnings per share. They do it through acquisition. So there's the old saying of show me the incentive and I'll show you the behavior. So you've seen this in various industries like beverage, with InBev growing through acquisition when their previous CEO was incented to do that. So show me the incentive, I'll show you the behavior. So the the pay packages with the shares drive that executive team to grow through acquisition because it is the shortcut to growth. It seems like it's the easy route, but it may be a shortcut from a time perspective, but if you don't do it well, there are a lot of risks involved, especially transformational deals. The International Paper, DS Smith, those, relative size, 20 billion, 10 billion. It doesn't matter if it's a 10 million buying a 10 million or a 20 billion buying a 20 billion. Once you do a transformational deal where you have relative size, the risk goes way up because everything gets negotiated. People start playing politics, get into turf wars, game playing, all the way from the executive team down through the front line. So if you're growing through acquisition and you're absorbing smaller players into a big player, and you're clear that they're going to become part of your processes, your system, your brand, your operations, then it becomes easier. You don't want to be a conqueror and be heavy-handed about it, but everyone knows on the buy side and the sell side in those, growth through acquisition of a bunch of smaller deals that you're going to be absorbed and you're going to be part of the new big company. In the relative size, the transformational deals where relative size is about the same, that's where you see most of the problems happen. And, a lot of them destroy value. There's some studies, there's a major one that's done a few years ago. 2,500 deals were examined, global deals, in publicly traded companies, and 60% destroyed shareholder value. So you hear these statistics all the time. What I've seen over the years as a consultant, as well as a faculty member in the business school, is, everybody thinks they're going to be part of the 60% or the 40% that at least don't destroy value or add value. And nobody's going to be part of the 60%, but the statistics say that, almost 2/3 are going to fail or destroy shareholder value. So somebody's fooling themselves.
And that's just as possible, entirely possible for the International Paper deal as much as anything else then.
Absolutely. If they don't do a good job of, the integration, the back office, the operations, the technology, the people, the culture, there's a lot of problems that will occur. Yeah, absolutely.
That's really interesting insight, actually, a little kind of glimpse at the workings of these things, which, as I say, I'm by no means an expert on. More generally, Tim, I know, as you say, you've sort of been witnessing the kind of evolution of the M&A market for around 30 years now, possibly longer. How can we see this kind of evolution as broadly indicative of the state of the economy as a whole? And what kind of fluctuations and trends have you seen against the various different, global economic and political backdrops?
Yeah, I mean, deals come in waves. Either globally, as the global economy is rising, you'll see transactions are a reflection of that rising economy. Companies are doing well, they have money. You can fund your deals either through debt or cash, your own stock, or some combination. And within industries, you'll see the stronger companies go on buying sprees because they have that capability to either use their own cash or their stock is in a rising position, or they have access to the capital markets and can raise debt to do the deals. So it's really fluctuates. And then you'll see valleys. We're in a valley right now. We had a M&A wave. So there was about a 10-year M&A wave after the crash of 08, 09 in most industries globally. That began after the crash. It lasted for about 10 years until 2019 when COVID hit. Then that wave ended. Obviously, everybody locked down during COVID, wanted to see what was happening globally across industries and geographies economically. And then it started to pick up again, kind of midway through COVID, a couple years in, when there was obvious winners and losers during COVID. Anything online, their stock was doing well, their cash flows, anything brick and mortar. Delivery was a big thing, so packaging did well, obviously. And then we had, another black swan event with the Russian-Ukrainian war, and you know, last year was the worst year in M&A. So that short wave hit for a year or so, and then that ended of M&A. Last year was the worst year we've had in over a decade. This year it's starting to pick up a bit in the first half of the year. It's not back to super healthy levels, it being the M&A market, but we are still seeing it. When you say, M&A is in a valley or a trough and not a wave, it doesn't mean it's gone to zero. It just
No.
means that, it's not, what was it, 4.5 trillion? It may be, half that, but that's a big drop, right? So compared to a year-on-year growth or contraction. So we'll see. This year, the economies are starting to look okay, depending on where you are. There is a lot of money out there, both in the private markets as well as the public markets. So we'll see whether this is the beginning of another wave. It is starting to pick up. You're seeing some bigger deals announced, or at least being pursued, like the International Paper deal, DS Smith. But the jury's still out as to whether this year is the beginning of the next M&A wave.
Yeah, I was going to say it's still even that particular deal, it still seems kind of in the balance. So we're obviously following it with a lot of interest. But I was going to ask you about this potential kind of upswing in M&A activity we've been hearing about. So you feel that's maybe a little bit optimistic? We just have to wait and see, basically.
Well, the market will self-adjust, right? And it's a myriad of factors. It's interest rates, obviously, have made the cost of capital, raising debt is more expensive for the private markets and the public markets. The way you value a company gets changed when the cost of capital goes up, when it, actually costs money to borrow money. It was pretty much free for a long time, or close to free. So there was a lot of M&A occurring. So that's one aspect. Another aspect is the regulatory environment that we talked about a few minutes ago. A lot of regulators are more aggressive these days in the EU, the US, the UK, not just from a market power perspective, but national security. The umbrella, it used to be aerospace and weapons, and now it's anything that has data, infrastructure. Is being scrutinized by the regulators. So, there's a myriad of factors that come into play of whether an M&A market is going to be a rising market, and there's some questions still. So it's ticking up, but it's not, full steam ahead at this point.
Interesting. Perhaps I can come back to another point, Tim, when this story moves on a bit. It'll be good to get some more insights from you. It's been really kind of illuminating for me today, and I hope for our listeners too. Before I let you escape to get on with your day, is there anything else you'd like to draw our listeners' attention to? I noticed, for example, that the Saïd Business School has been involved in the publication of the Global Annual M&A Survey. Is that right? So we can include a link to that in the show notes.
Exactly, and it's a joint survey that we do in partnership with Global PMI Partners every year, mainly about success factors. And what I would say to your listeners and your readers is, we think about M&A, and when you hear the phrase M&A, mergers and acquisitions, everybody thinks about the deal. Right? They think about the financial analysis, the valuation, how much are you going to pay as a buyer? How much are you going to sell for as a seller? That's absolutely important. Price is very much a big part of M&A. You need to know what price a company or an asset's worth when you buy it or you sell it. So that's very important, but it isn't the only thing. Obviously, there's legal elements, the regulatory, all the contracts, what's called your share and purchase agreement, et cetera. But I've spent my entire career trying to bridge the deal makers, that front end work around what's your deal strategy, targeting companies that fit it, doing good due diligence and good valuation negotiation to get the deal to close or complete, as they call it here. But then, the bankers are on to the next deal, the attorneys are on to the next deal. But really, value at that point has only been analyzed, projected, and agreed. Value is created post-deal. So I've always seen myself for the last 30 plus years as the bridge between the deal makers and those that make deals work, the operators that have to implement the back office cost reduction synergies, the operational cost reduction synergies, the revenue growth, all those projections that go into a financial modeling around where are we going to save costs, where are we going to grow, that all has to be implemented. And it has to be implemented well. And those that do a good job of that as a buyer are the ones that win in M&A because they actually create value post-deal. It's not just about projecting and agreeing value pre-deal. So people need to think about M&A as the full spectrum, all the way from the beginning to close and then post-close integration and success measurements. So that's kind of what I would like to leave people thinking about.
Wonderful. Okay. Well, thank you so much for your time, Tim. And as I say, I hope we will hear from you again in future. I'd also, as always, like to thank our listeners and to point out that there will be a longer report on this topic on the premium section of our website over the next few weeks. So do look out for that if you'd like to know more. Have a good day, everyone, and goodbye.